Learning Objective 4 introduces us to an expanded version of the income statement called a multi-step income statement. What you've been focused on, what you've learned so far in the earlier chapters is technically what we would call a single step income statement, which basically we subtract the total expenses from the total revenues and we get a net income. We don't show any other breakdown other than that. Okay. It's the simplest thing to do. It's very, very easy to read, and you've seen them before. Here is a single step income statement for REI. Remember that company is this like a sporting goods, outdoors goods type of company. And this is their income statement for two separate fiscal periods. Okay, two separate fiscal year. The first fiscal year listed to the far right um, ended December 28th of 2013. And then the following fiscal year, which you would think would end December 28th, 2014, actually ended January 3rd, 2015, about a week later. Okay. So, but these are back-to-back income statements in essence. As you see, the total revenues are listed. And what did I tell you here? Why you need to know net sales is because you're going to see net sales everywhere on these income statements for merchandising companies. So net sales are listed first. The expenses are listed second and totaled. And then they end with your profit, right? Your net income is here. It's important to know how to read these. All of these numbers are in thousands, which means you would have to add 3 zeros to all of these numbers to read it correctly. So, for example, their net sales for their fiscal year ending December 2013 it looks like 2 million, but when you add 3 zeros, it's 2 billion. Okay, 2 billion. And their sales increased to 2.2 billion. So that's almost a 10%, about a 10% jump in sales. And that for a retailer, that's really, really good. Anything double digits is really, really good for retail. Notice all the expenses that are listed. And as I mentioned to you earlier, the cost of goods, right? The actual inventory that they go ahead and they buy it and then they sell it, right? Is their largest expense. And this explains why you have a perfect model in what Walmart started way back in the late 80s, early 90s, and it accelerated through the 90s until now, is that they, of all of their imported goods, 80% of those imported goods are made in China. And that's because of the cost for the inventory. Okay. Because when they buy the inventory, it's their asset. But when they sell, right, the inventory is their asset. When they sell it, it's the cost of goods sold. It's an expense. So, like any other business, they want to keep their expenses low. And so what you've seen with companies like Walmart, and Walmart was the best at it, and it basically drove everybody else to follow that model, is they drove the cost of goods down by basically telling manufacturers, many of who are US manufacturers, that you can't make stuff cheap enough in this country. You have to make it in places like China, but basically China is most of it. And so, so a lot of manufacturers set up shop in China to manufacture goods, basically to sell to places like Walmart. And so a lot of people just don't understand the full scope of the story. They think something notorious was happening, but it's simply a business decision that was made. So it's not necessarily, any one particular's fault. Walmart was very good at doing this. Everybody else is doing it as well. So don't blame China, don't necessarily blame Walmart. It was just it was an eventual process that led to all of these things happening. So again, it's the biggest expense. As you see, cost of goods sold is the largest expense that retailers and merchandisers have. Much bigger than labor. Payroll is labor, right? Much bigger than labor, 3 times as large as labor almost. So, so this is a really important issue, which is why it's a globalized supply chain. Because the purpose of the retailer is, of course, is to get as many goods at a lower price. And to do that, they've basically shopped the globe. And globalization's allowed that to happen. And so that's good. So in essence, REI went from an $18 million profit. Remember, you got to add 3 zeros. All these numbers are in thousands. To a $44 million profit. So that's more than double profitability, which is terrific, which is really terrific, right, for them, because you want to see this company, all the stockholders want to see the company continue to earn higher and higher net income. What you're going to be learning later in the chapter is comparing numbers like the net sales to the net income. I mean, think about it. This company in the fiscal year that ended January 3rd, 2015, they collected $2.2 billion from customers in sales. But after they paid all their bills, they only had $44 million left as a profit. So you go from 2.2 billion down to 44 million. That tells you a lot about retail. There's a lot of expenses. There's a lot of expenses in retail. A lot of people don't really kind of get that idea very well. But retailers are not making tons of money per se unless they start selling lots of goods. Because if you started with, and we're going to do a calculation on this later on, but I'll show you real quickly here. If you ended up with $44 million on sales of $2.2 billion, you're only keeping about 2 cents out of every dollar as a profit, which means that for every dollar the customer gave you by selling them something, you spent, in this case, REI spent almost 98 cents of it just to pay their expenses. And they only kept about 2 cents of every dollar as a profit. You'll see that through and through and through. So that's something to sort of understand as well. The multi-step income statement breaks down the income statement into a few parts that are very important. One, we've already talked about, is it actually gives you the gross profit. Remember, the gross profit is the sales revenue minus the cost of goods sold. That gives you the gross profit. So that's important to know, because the cost of goods sold is simply that the only expense that represents is inventory. Okay, it doesn't represent any other expense other than the cost of their inventory. So the gross profit is the basically remaining amount of sales revenue they have after they've paid for the goods they just sold you. That has to cover all the other expenses and give them net income. Okay, so the gross profit is a very important figure, as you'll see in this concept. Another thing the multi-step statement does that other income statements don't do is they'll give you the profit from the main operation of the business. Now remember, the word income and the word profit and the word earnings all mean the same thing, interchangeable terms. It means profit, okay? Now, the income or the profit from operations means the main business of the retailer. So for example, you've gone to the Walmart, I'm sure, perhaps in Fishkill, perhaps up in Kingston. When you walk into the Fishkill Walmart, you'll notice that there's a McDonald's there. You'll also notice on the other side, there's a type of a hair salon, right? A beauty salon there. Well, Walmart doesn't own McDonald's, and Walmart doesn't own that beauty salon. They do own, by the way, the eye glass place that's there. They're renting that space to McDonald's and the beauty salon. So that's basically other things that Walmart does. Walmart's not known as a landlord, right? You don't go to Walmart and say, I want to rent a space. You go to Walmart because they got tons of goods. Their main operation, that's that term, the main operation of Walmart is to sell goods. The fact that they do other stuff, clearly, they're a landlord. They're renting their space to McDonald's. They're renting their space to other businesses in their big superstore centers. They're making money from that too, but it's not from selling goods. It's not their main operation. So step 2 tells you the profit from the main operating activities of the business, which is a very important thing because these companies are quite large and they might do other stuff other than sell goods. But the purpose of retail, remember, is to sell goods. That's their main purpose. They might do other stuff, but this is their main stuff. So this tells you about the income or the profit from selling goods. And then the third thing the multi-step income statement will tell you is, of course, the net income, right? After all is said and done, what's left for them. So that's very important. So here is the multi-step income statement for REI, same company, actually the same 2 fiscal years are listed here, except now it's broken into the multi-step, okay? So first thing that's given to you is the gross profit. Is the gross profit. So for the most recent year on this income statement, they collected over $2.2 billion in sales, right? Look, again, that's net sales, right? Sales revenue minus sales returns allowances minus sales discounts, net sales. You have to know that. Minus the cost of the inventory. That's it. That's all thing. That's your gross profit. So after they subtracted out the cost of inventory, their gross profit was not even $1 billion, 960 million. That 960 million has to pay for all the other expenses that the company has, and the company has a lot of them, right? Operating expenses include things like labor costs, right? Things like rent expense and all the other types of expenses. That gives them their profit from operating. So here, I mean, it's really interesting to know, particularly when you compare the previous year's data to the current year's data. The profit from simply selling recreational equipment is clearly profitable for them. They had a huge increase in profits from 129 million to 181 million dollars in profits. That's a really large increase. So the company, that the main business of the company, which is selling goods, has been very profitable to them. What's the difference between that and the net income? Well, there's all that other stuff that companies do that I told you about, right? That other stuff includes, for places like Walmart, renting space to McDonald's in their store, right? That's not selling goods. So it's certainly not sales. They have to put it down as other, right? So this, what I like about the multi-step income statement is it tells you all the other stuff the company has been doing and making money or having expenses from. So here they have other revenue and gains, other expenses and losses. Okay. Other stuff other than the main operation of selling goods. So these are other activities the business is doing that is not related to selling goods. Mm-hmm. So here they have these patronage refunds. Clearly that's eating up most of the profit, the operating profit. Then they subtract out their estimated tax burden as an income tax expense, and that's what leaves them with their net income. Okay. But clearly, of the $181 million they made in a profit from their operations, they're giving most of that to whatever these patronage refunds are. And of course, they have to put aside money for tax expense. So that's a lot to drain. So I don't know what these patronage refunds are about, but I would want to find out why it's taking up so much of the operating profit and taking away from the net income for stockholders. So very important to sort of go through all of these. Remember, net sales are sales revenue minus sales returns and allowances minus sales discounts. I told you needed to know that, and here it is again. Your gross profit is the difference between your net sales and your cost of goods sold. Okay. All your operating expenses are listed then, giving you your profit from the business. This is for PW audio, by the way. Okay. Then all the other stuff, right? Other revenue and gains, other expenses and losses, other stuff the company is doing that's not related to selling merchandise. It clearly has an impact. Then they set aside some money for their income tax expense and they get net income. So you have to sort of know, and the book kind of goes through each of these so you can understand that. You don't have to worry about comprehensive income. What we're doing with comprehensive income is simply reporting any unrealized gains or losses in addition to the net income. But this is something that you'll get in sort of an intermediate accounting class. So I'm not going to focus on that here, but it is part of that. I'm just explaining briefly what it is. Again, we're focusing on the basics of the income statement and not going much deeper than that. Okay. So your do it exercise for number 4 is all about, surprisingly, the multi-step income statement. Yay. Okay, so there it is. So sorry to say you are going to be doing an income statement here, but it's just more or less for show and tell. And it's mostly, a lot of it is done for you. So here you have the Art Center Corporation. Clearly, they want you to prepare the multi-step income statement. In this case, they did also want you to include your comprehensive income, but that's just adding this at the end of it all. And you have to estimate the company's tax on the net income. So the tax rate on the net income would be 25% of net income would be the income tax expense at the end of it. So how does it start? Well, you know how it starts. Sales revenue minus sales returns and allowances is not there, but sales discounts are. So these two are going to give you your net sales. Yes. So that's how it starts. What happens after that? Well, you know what happens after that. You subtract out your cost of goods sold. That gives you your gross profit. What comes after your gross profit? All your operating expenses get subtracted from your gross profit to give you your, in this case, your profit or income from operations. Okay. What comes after that? Well, remember that other stuff that the company is doing. You're adding in the other revenue, you're subtracting out the other expenses, and that's going to give you your net income before the tax. You're going to go ahead and calculate 25% of that as the income tax expense to give you your net income. How it looks is right here. This is all in your book. Net sales, again, very important to know how to do that. Minus cost of goods sold, your gross profit, right? Minus all your operating expenses, your income from operations. All that other stuff, right? Adding the revenue and gains, subtracting out the expenses, other expenses and losses, that's going to add $5,000 to the profit. That's your profit before the taxes. Take away whatever rate they give you. In this case, it's 25%. Income tax expense will give you your net income. From that net income, we would either add or subtract the other comprehensive income, which I'm not requiring you to do. All right. Before we get started on this, quick break for questions on that. It's a very, it's a great statement. It's a great statement to know, for sure. You'll have to trust me on that. Okay. Learning objective 5. I don't see anybody's faces, so I can't tell if you're like rolling your eyes back or not, but I'm assuming you are a little bit. Learning objective 5 brings us actually all the way back to learning objective 1 when I went over how they track inventory on a periodic system, which is literally sort of a hand counting system, right? Everything starts with what's already in the store at the beginning of the period. We call that beginning inventory. Remember, the merchandisers are buying inventory all the time. So we're adding all of those costs to the inventory. That's going to give us a grand total of the total inventory that's available for sale. Like I told you, only 2 things can happen to inventory once a company has it. At the end of the period, they still have it. If it's not there, it's assumed it's sold. So they subtract out what they count left in inventory. If it's not there, they assumed it's sold. That's cost of goods sold. Okay. So this particular, this is the tabular form of what that box system looked like. You had the beginning inventory plus all the cost of goods sold gives you your total. Remember, step 1, step 2, step 3. And then your total inventory is either going to be part of your, if it's there, it's going to be ending inventory. If it's not there, cost of goods sold. Remember this from learning objective 1, that box system. This is what this is in tabular form. Okay. Relatively easy to do. This is what it would look like if we were to put it together formally in a statement. You would take the beginning inventory that the company had at the beginning of the period, which in this case is January 1st. You're adding in all of the goods that have been purchased, but notice that purchases have a lot going on, right? You bought a whole bunch of stuff, but then you sent stuff back, right? So that gives you your net purchases. So if you bought $325,000 worth of goods, you sent back 17,200, or you got discounts on that. So that's your net purchases, but then you had to pay for freight, so you had to add that in. So the 320 here is the total of all of that process. Buying inventory, subtracting out what you sent back or what you got a discount for. Remember, this is the buyer. Adding in your freight, that gives you your total cost. You add your beginning inventory to your total cost of goods purchased. So the total amount of goods available for sale cost you $356,000. Okay, that's the third step here. That's that middle box in that scheme of things there. At the end of the period, we count what's left, right? So you have $40,000 of this inventory still in the store. What do we assume? We assume we sold the rest, cost of goods sold. So this is what it looks like in a form. So again, it's that this is an important thing to remember, and that's your learning objective 5. Calculating the cost of goods sold using the periodic system. So here you have the accounting records for Aerosmith, right? And they want to know first the cost of goods purchased, and secondly, the cost of goods sold. Okay, so everything starts with beginning inventory, right? That's the first thing that's going to be listed as your beginning inventory. The second thing you're going to add is the cost of all your purchases. Well, it looks like you have a little bit of math to do. You're going to start out with the purchases that you made. You're going to subtract out the returns and allowances. You're going to subtract out the purchase discounts, and you're going to add in the freight. And that's going to give you the cost of the purchases. Total those two numbers up. And that's the cost of goods purchased. Right. You subtract out your, that's the total available for sale, rather. You subtract out your ending inventory, and that's the difference is your cost of goods sold. So how does it look in the table? You start with beginning inventory. You take your purchases. You subtract out your returns and allowances, subtract out your discounts, add in your freight. So you bought $160,000 worth of goods. Adding it to the beginning inventory gives you the total amount available for sale. Subtract out your ending inventory. The difference is not there. We assumed it's sold. Cost of goods sold. And the very last thing we do in this chapter is two financial ratios. Two financial ratios, which are very important to know. The first one is called the gross profit rate. It used to be called the gross profit margin. It still is. Sometimes it's called markup. But either way, it's a very, very important rate to know. And it's very simple to calculate, thankfully. The gross profit rate, as you see here at the top, is simply the gross profit divided by net sales. That's it. That's it. So remember, the gross profit is net sales minus cost of goods sold. That's your gross profit. We're comparing that back to the net sales. Back to the net sales. So for REI, let's focus on 2014. For REI, they had cost of goods, they had a gross profit of $960,129. This gross profit is given to you on the multi-step income statement. But even if it weren't, you can still calculate it, right? It's net sales minus cost of goods sold. So it's easy to calculate. We divide that over the 2.2 billion in sales, and REI has a very healthy 43% gross profit rate. Now, this is important. I mean, if you ever watch Shark Tank, which I'm sure a lot of you probably do at one point in time, that's one of the big questions that they'll have for businesses. What's, not only what your sales are, what's your gross profit, what's your margin, right? They'll always ask about that, or they'll do it inadvertently by saying, okay, what are you selling it at and what's your cost? And they're still calculating the gross profit margin either way. So this is a very important number and a very important percentage, because again, from the gross profit, all the other expenses of the business have to be paid for there to be a net profit. So this has to be high enough to support all of that. It seems like REI has a very good gross profit margin. Dick's Sporting Goods, if you put their gross profit over their net sales, they're 31%, so significantly lower than REI. And so that is something we're going to be looking for. Is Dick's able to control things on the other end to get a profit? Because certainly 31% is not as high a gross profit rate as 43%. And remember, from the gross profit, all the other expenses have to be paid. The industry, again, this is the sporting goods retail industry. So if you look at all the stores, their average is 34%, 34% gross profit rate. Now, another way to look at this, by the way, is, and I'll put it up, it's kind of hard. For every, another way to look at this is, for every dollar the customer has given the business, after they subtract out their cost of goods sold, so this dollar is sales revenue. After they subtract out the cost of goods sold, right, this is what's left for gross profit. So for REI is, okay, for every dollar they collect, they have 43 cents in gross profit. So from this, you can tell that REI has a very low cost of goods sold. They're only spending 57 cents on cost of goods sold because that leaves them 43 cents in gross profit. For Dick's Sporting Goods, for every dollar they're collecting from the company, they're only left with a 31-cent gross profit, which means they're spending a very large amount, right? 69 cents on cost of goods sold. Right? The industry is a little bit better than that. The industry is spending about 66 cents out of every dollar they collect on cost of goods sold, leaving them for 34 cents out of every dollar for gross profit. That's important to know. This is how we calculate it, breaking it down into a dollar. Okay. When you know what the percentage is, you can use it on a dollar. And so for every dollar in revenue that the company is getting, you know they're subtracting out cost of goods sold to get that gross profit. So if you already know the gross profit has that percent, it's a percent of a dollar, every dollar. Excuse me. So that's important to know. That's important to know. All right. So clearly REI seems to have an upper hand. 43% gross profit margin is extremely high compared to the industry. All right. So again, it's not about gross profit totally. It's at the end of the day, it's about profit. So the profit margin basically looks at the net income compared to the net sales, right? At the end of everything, at the end of that income statement, there's net income. Okay. So how much of that net income compared to your sales, right? Compared to your sales, that's what the profit margin looks at. And that's also important. So again, it's simply the net income, right? The net profit, the net income divided by net sales. So REI, if you look at their numbers for 2014, they had a $44 million profit. Their net income for 2014 was $44 million, but they started with over 2.2 billion in sales. So their net profit was 2%, right? That means if you look at it from a dollar, for every dollar they collected from their customers, they were keeping 2 cents of every dollar as their net income. Now, here is where Dick's Sporting Goods is master here, because for every dollar the customer gave them in net sales, they were able to keep over 5 cents of that dollar. Okay. Which is basically what the industry does. Okay. So in terms of overall profitability, Dick's Sporting Goods and the industry as a whole is doing a much better job than REI. So which is different, because we learned earlier in the gross profit that Dick's had a much lower gross profit margin. In other words, they were paying a lot for their inventory. Their cost of goods sold was very high compared to REI. But clearly they have a strong grip on all their other expenses in order to squeeze out a nickel from that. Okay. Unfortunately, it looks like REI does not have as strong a grip on all the other expenses that it has. It clearly has a great gross profit margin, but it's not able to capitalize on that by keeping more of it in net profit for a profit margin. Okay, so these are very, very important. You can apply this to any company at all. Okay, this is something that analysts do in finance all the time. This is one of my favorite things to do. And you'll see that on, again, if you watch Shark Tank, you're going to hear this, particularly that gross margin, very, very important. Cost of goods sold, very, very important. They're always looking at those higher margins because they feel as though with a high margin, if you're not controlling the costs, they're going to help you control those costs. And that's important. So here is Rachel Rose information for 2017, listed in the first column, 2016 in the second column. And they want, again, the gross profit rate is the first thing they want, and then the profit rate is the second. So first things first, gross profit rate is the gross profit divided by your net sales, right? Well, the net sales are given to you for both years. That's easy. But the gross profit is not given to you. So how do you calculate it? Net sales minus cost of goods sold will give you your gross profit. So you can calculate that pretty easy. The profit margin is the net income divided by the net sales, right? It's the net income on the top, net sales on the bottom. That'll give you your profit margin, right? And so again, that's relatively easy. So what you've got here is the gross profit rate for 2017 is 50%. For 2016 is also 50%. So for this particular company, they have a 50% gross margin or a 50% markup. For their, this should be the profit rate, the profit margin rather. It's going to be the net income over net sales. And as you see, they increased from 16.7% in 2016 to over 22.5% in 2017. So they're keeping a lot more of every sales dollar as their profit. And that's a very good thing. That's a very healthy thing. Okay, questions?